In the case of these stocks, stability and growth go hand in hand. These are the top blue-chip stocks the Nasdaq has to offer. Texas Instruments. Free cash flow generation is one of its greatest strengths. Fastenal. E-commerce is driving sales for the industrial distributor. Paychex. It's not the largest provider of human capital management services, but it is one of the most consistent. Let's dive in. Here are the 3 best blue-chip Nasdaq stocks to buy now. Welcome to Timely Investment Research. The Nasdaq 100 Index is generally considered the de facto proxy for Nasdaq-listed stocks, so it makes sense to pick from this index if you're looking for the best blue-chip Nasdaq stocks. Invesco has the most popular Nasdaq 100 ETF, the Invesco QQQ Trust. It has 101 holdings. I believe that's because Alphabet has 2 share classes included in the index, with nearly $174 billion in net assets. But it's not the only Nasdaq 100-focused ETF. In October 2020, Invesco launched the Invesco Nasdaq 100 ETF. It did so to provide investors with a cheaper version of the Nasdaq QQQ Trust. It charges 0.15%, 5 basis points less than QQQ's 0.2% expense ratio. It has $8.9 billion in net assets. Invesco also has an environmental, social, and governance (ESG) version, the Invesco ESG Nasdaq 100 ETF. And Direction puts out an equal weight version, the Direction Nasdaq 100 Equal Weighted Index Shares. You get the picture. For my list of the best Nasdaq blue-chip stocks to buy now, I've used 3 criteria to narrow the field. They must 1. Have a dividend yield of at least 2%. 2. Have total debt of 10% or less as a percentage of market capitalization. And 3. Generate at least $100 million in free cash flow. Number 1. Texas Instruments. Dividend yield, 3%. Total debt, $10.1 billion, 6.7% of market cap. Free cash flow, trailing 12 months, $4.4 billion. Texas Instruments reported first quarter financial results on April 25th. Revenue was $4.38 billion, $10 million more than the analyst estimate. On the bottom line, it earned $1.85 a share, 8 cents higher than the consensus. Unfortunately, the company's guidance for second quarter revenue was $4.35 billion at the midpoint of its outlook, $90 million less than the analyst estimate. Revenue decreased 6% sequentially and decreased 11% from the same quarter a year ago. Chief Executive Officer Haviv Ilan said in the accompanying press release. During the quarter, we experienced weakness across our end markets with the exception of automotive, as expected. However, long-term investors shouldn't be put off by the near-term headwinds. Oppenheimer analyst Rick Schaefer raised his price target on the stock by $10 to $195 following the company's earnings announcement, while maintaining his outperform rating. We see 2023 as a correction year for Texas Instruments and the group. Industrial slowdowns likely spread to auto in second half, Barron's reported his comments. Texas Instruments remains a premier diversified free cash flow return story. We are long-term buyers. Texas Instruments is as shareholder-friendly as it gets. Number 2. Fastenal. Dividend yield, 2.6%. Total debt, $648.1 million, 2.1% of market cap. Free cash flow, trailing 12 months, $767.2 million. Fastenal reported better than expected first quarter results on April 13th. On the top line, revenue increased by 9.1% to $1.86 billion. On the bottom line, net earnings grew by 9.5% to $295.1 million. In addition, diluted net earnings per share rose 10.4% due to fewer shares outstanding. One area where the distributor of manufacturing and building supplies is doing well is its e-commerce sales. In the first quarter, they rose 48.7% year over year and accounted for nearly 22% of total sales. As we've seen in prior quarters, we continue to see really strong growth in e-commerce. CEO Dan Florness said in the first quarter conference call. Recall that last fall that broke 20% of revenue for the first time. In a Bloomberg opinion piece, Brooke Sutherland offers a note of caution, pointing out that Fastenal's sales to non-residential construction customers have declined for 2 consecutive quarters. a sign that companies are tightening spending to brace for a potential recession. Long-term, though, this is a financially sound blue-chip Nasdaq 100 company. Number 3. Paychex. Dividend yield, 2.9%. Total debt, $870 million, 2.2% of market cap. Free cash flow, trailing 12 months, $1.5 billion. On April 28th, Paychex announced it would increase its quarterly dividend by 13% to 89 cents a share with the May 2023 payment. As a result, in fiscal 2023, May year-end, it will return $1.2 billion to shareholders through dividends. As for share repurchases, it only buys back its stock to account for dilution purposes. It didn't buy back any of its stock in the third quarter from its $400 million stock repurchase authorization. It has $327.1 million outstanding. Starting this month, Paychex will no longer process direct deposits or provide other services for cannabis-related companies. Cannabis-related businesses continue to face significant banking obstacles because major banks will not allow electronic fund transfers from cannabis-related businesses over their networks, typically because of differing state and federal regulations around cannabis, the company wrote in a memo, according to MG Biz Daily. It's another disappointing blow to the cannabis industry. However, any resentment the industry might have toward Paychex should be redirected at the banks and state and federal legislators. Of course, they live in the Stone Age, but I digress. Through the first 9 months of fiscal 2023, the company generated revenue of $3.78 billion, 9% higher than a year earlier. Its operating income of $1.58 billion was also up 9% from a year ago. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.